While the world was distracted by the headlines, the global monetary plumbing just sprang a massive leak. As Western exchanges sat frozen over the weekend, physical silver in China didn't just move, it decoupled. We are seeing buyback prices in Shenzhen hitting $120 an ounce, a $27 premium over the paper price you see on your screen. This isn't just volatility, it is a structural divorce between the price and the stuff. Drop a crux in the comments if you've been watching these premiums, and you're actually paying attention to the physical paper disconnect. Are you holding physical? Or are you still trusting the digital digits? Let's get into the data. Subscribe to Market Crux to stay on the right side of this transition. In an era of deep fakes and clones, this is the only official Market Crux platform where we prioritize raw data over retail hype. No courses, no fluff, just the structural truth. The primary driver is the confirmed decapitation strike in Tehran. Iranian state media has officially confirmed that Supreme Leader Ali Khamenei has been killed following coordinated U.S.-Israeli airstrikes under Operation Epic Fury. Former Iranian President Mahmoud Ahmadinejad was also killed in a separate strike, according to Iranian media and Fox News. This isn't speculation. Two of Iran's most powerful figures are gone. Many thought news of the Supreme Leader's death might de-escalate tensions. The opposite happened. The Iranian military apparatus has moved into a dead hand protocol. Iran has launched over 540 drones, 165 ballistic missiles, and 2 cruise missiles since yesterday. While 152 ballistic missiles were intercepted by the U.S. Fifth Fleet and regional air defenses, 35 drones hit land, with 21 striking civilian targets in the UAE this morning alone. The UAE has been turned into a functional war zone. 3 people have been killed, 58 injured from various countries, with moderate damage to civilian homes and property in Dubai and Abu Dhabi. Iran then targeted the U.S. aircraft carrier Abraham Lincoln with 4 ballistic missiles. Iranian Revolutionary Guards confirmed the strike via state media. Whether those missiles connected or were intercepted, the intent is the message. Iran says it will not bow to its enemies and will continue responding with strength. No red lines anymore. This isn't a regional skirmish, this is a regime-ending objective playing out in real time. Now, here's where physical markets separated from reality. Everyone else is watching the news. We are watching the vaults. China's Dashang Bank just issued a notice that if there's a big deviation in price leading to depletion of accumulated gold liquidity, trading will be closed. A huge amount of yuan savings are waiting for market open Monday. The dark market touched $6,000 per ounce for gold this weekend. Not yuan, but $6,000 USD. Look at the crypto rails. PAX-G, tokenized physical gold, hit $5,600 yesterday and is currently trading near $5,400. That's a $124 premium over Friday's spot close of $5,278. Crypto never sleeps, so the premium runs wild while traditional markets stay closed. According to a Chinese commodities trading advisor, the Shenzhen physical silver buyback price is north of $120 per ounce because most small Chinese silver distributors are not selling their physical silver in fear of a total lack of supply. IG weekend spot silver is trading near $100, Hyperliquid showing $96, Shanghai spot at $105, Shanghai futures at $108. Western spot closed Friday at $93. That's a $7 weekend premium on IG, a $12 premium on Shanghai spot, and a $27 premium in Shenzhen over Western paper. 3 assets matter now: gold, the monetary reset hedge; silver, the industrial shortage play; and oil, the energy that cannot be printed. These 3 trade on necessity, and all 3 are spiking together while the world's most critical energy choke point, the Strait of Hormuz, is effectively closing. Roughly 20% of global seaborne oil trade flows through this strait. It's not technically shut by a blockade, but it is functionally frozen through insurance. Ships traveling through Hormuz must purchase war risk insurance protecting shipping companies from attack costs. If insurers refuse coverage and ships stop sailing, oil flows effectively stop even if the waterway remains open. 2 vessels have already been attacked: a Palau-flagged oil and chemical tanker named Skylight near Kasab, and a second ship named MKD Vion. Both are on fire near the entrance of the strait. Insurance costs for a $100 million oil tanker jumped from $250,000 to $375,000 per voyage in 24 hours. 150 tankers have dropped anchor in open waters, refusing to move, sitting off the coasts of major Persian Gulf oil producers. Maersk has suspended all Strait of Hormuz transits. Brent oil prices are trading up 10% around $80 per barrel, holding gains and refusing to give them back. This is a violent negative supply shock. Roughly 20 million barrels per day of oil are frozen, plus 100% of Qatar's world-leading LNG exports are suddenly blocked. But Iran's strategy goes beyond just Hormuz. This is a calculated maritime assault targeting key ports. They hit Duqm in Oman, a port specifically built to bypass Hormuz risks. They struck Jebel Ali in Dubai, which handles 60% of UAE imports, crippling the non-oil economy. They attacked Mina Salman in Bahrain, home to the U.S. Fifth Fleet, and Haifa in Israel. Iran is demonstrating that you don't need to sink ships to win. Igniting ports wins the economic war. Patriots can't protect Jebel Ali's cranes from drone swarms. Every Gulf exporter feels the premium, repricing the global tanker fleet overnight. The importers are taking the biggest hit. Japan relies on 75% of its oil via the strait. Japanese tankers are already turning back. South Korea gets 60% of its crude through Hormuz. India sources 50% of its crude and 60% of its LNG from this region. Fuel prices will skyrocket, putting the rupee under immense pressure. China is the largest absolute buyer at 55 to 60% of crude imports via the strait. While they have diversification through Russian pipelines, they still feel massive price pain. Iran's port strategy is textbook asymmetric warfare. You can't protect every terminal with carrier groups. They are igniting infrastructure that cannot be defended. This is economic warfare meeting energy warfare. Friday's video walked through gold, silver, and oil spiking together. China has ordered its citizens to leave Tehran. $650 billion was added to the metals market cap this weekend. I said markets were pricing scenarios most won't discuss. Now those scenarios are the headline. Now for the resistance case. Honesty matters. Weekend premiums capture the directional trend, but often overstate the actual gap. Markets open in hours. Futures can gap then fill. Strikes could de-escalate, or Hormuz could stabilize if insurance recalculates. Banks have a history of coordinating paper slams during geopolitical events to protect their short positions. However, Iran just said no red lines. Officials confirmed airstrikes will continue for days. Israel has stated regime change is the explicit goal. Houthi rebels are resuming Red Sea attacks. This is sustained military operations with regime-ending objectives. Underneath all of this, the structural metals deficits haven't changed. We are looking at 10 consecutive monthly green closes on silver and gold's 7th straight record. The industrial demand for silver hasn't stopped. Solar, EVs, AI data centers, 5G, and military defense require more silver than the world is mining. Mine supply cannot keep pace. Central banks are still buying gold at record rates because they know the fiat system is being tested. Silver lease rates have been spiking for 6 days straight before this weekend's news even broke. When Western markets open tonight, watch these specific things on the Market Crux dashboard. The gap size. Watch gold and silver futures. If they gap up and hold, the paper slam has failed. The Shanghai premium. If the premium in China widens past $27, the East is officially leading the price discovery. Insurance levels. Watch the tanker anchor counts. If they don't move, oil goes to $120. Precious metals are likely to gap significantly higher. IG weekend spot silver is near $100. Kinesis silver is at $100. Hyperliquid is at $96. PaxG gold is at $5,400. These aren't random numbers. These are physical-backed crypto markets showing you real-time price discovery while COMEX sleeps. When physical markets trade $27 above the Friday close, that is your preview of the arbitrage. The data is clear. Physical buyers in Asia paying $120 for silver aren't going to sell at a loss just because a Western bank prints more paper contracts. The Strait of Hormuz is functionally frozen. Not in the headlines, but in the actual insurance pricing and the tankers sitting still in the water. This isn't financial advice. This is financial warfare education. 3 assets matter now in this environment: gold, silver, oil. Subscribe to Market Crux for the real-time gap analysis and the data drops as the markets open tonight. I'll be watching the tape. Invest with logic, not hype. Market Crux out.